You know, value means getting the best for what you need.
And you'll find this free Vodafone K3565 on Vodacom's MyMax 600 at $199 per month, absolutely invaluable. Because it comes with 600 megabytes of data and your SIM and connection free. So now you can browse and email at a very affordable price. Welcome to Broadband Central.
Over the next decade, 60% of global output is projected to come from emerging economies. What does this mean for global finance? CNBC will bring together key bankers and policymakers and ask, will emerging giants define the future? BRICS, Bucks and Beyond, the CNBC debate, hosted by Maria Bartiromo at the St. Petersburg Economic Forum.
Welcome to Investment 360, the show that focuses on fund managers, their investment strategy, as well as their performance. In the hot seat from our Cape Town studio, John Kinsley from Prudential of South Africa. John, thanks very much for joining us. I have still got Ashraf Mohammed from Regiment's Fund Managers in studio with me here in Johannesburg. John, we're focusing tonight on the Prudential Inflation Plus Fund. And just before the show, I sent out a note saying that you were going to explain why we need to have exposure to inflation-linked bonds. And so I think that's an appropriate place to start, given your exposure in this particular fund to inflation-linked bonds.
Yeah, Bronwyn, good evening, and thank you for inviting me. Essentially, the inflation-linked bond exposure, which is about 25% of the fund, is held there because of the real yield that inflation-linked bonds are offering at the moment. If you go back about 5-6 years in South Africa when our first inflation-linked bonds were issued, you could get about 5 to 6% real, which really was a no-brainer. Because if you were targeting a return of inflation plus 5 for your clients, locking into a 5% real yield was almost doing the job for you. They came down significantly to below 3%, which means that we lightened, but we've now gone back in because at a real yield of between 2.75 and 3, they're looking attractive, particularly relative to other assets. You know, the yield you're getting on cash is most unattractive. So one's got to do some relative yield calculations, and certainly that's why we are happy to hold a full 25% weighting.
John, it's Ashraf Mohammed here. You said that inflation-linked bonds made up 25% portfolio. What is the size of your equity holding in this portfolio at the moment?
Ashraf, we don't hold more than 30% in equity at any time, usually. And in fact, at the moment, that 30% is sitting 15% in South African equity and 15% in offshore equity.
We've just been discussing in the studio that there are a number of fund managers out there that have gone for their full offshore exposure, some 25%, but I suppose you're restricted by your overall 30% equity exposure in the fund. Is that why you are equally weighted between South Africa and offshore? You don't see bigger opportunity offshore?
Brodwin, we see bigger opportunity offshore than in South African equity. But let me say that our sort of strategic weighting, our long-term strategic weighting to equity would be close to South African equity, would be closer to 25%. So we've underweighted that quite significantly in favor of offshore equity. And certainly in the 10 years that we've been running this retail fund, it's the highest we've ever been offshore equity. We do hold a further 10% in offshore bonds. Which is only held in this portfolio because we regard offshore bonds as a great diversifier and almost as an insurance policy in a time of global uncertainty. So in this sort of more conservative portfolio, we hold 10% in global offshore bonds as well.
Just focusing on the global equity story, where specifically are you positioned? A number, again, of fund managers are deploying their money into the developed world from an offshore perspective, searching for value in the likes of Europe, despite the troubles there, and specifically in the US, where the sentiment appears that equities are relatively cheap.
Yeah, Brodwin, we see most value in developed Europe. We are very aware of the fact that there is risk. There's no question that the sovereign debt crisis there has most probably not reached its zenith, and there could well be some restructuring of default in another term. But having said that, the earnings yields you're getting in countries such as Germany, is the most attractive it's been in many years. In fact, up until recently, the dividend yield on certain German equities was higher than the 10-year German Bund. And you're not going to see that often. So, yes, we know there's risk in Europe, but we believe that in a country like Germany, you are being more than compensated for the risk you're taking. And remember, we're not investing for tomorrow. We're investing for our clients over the next 3 to 5 years.
John, Ashraf again, you spoke about a 10% holding in offshore bonds. Are you primarily focused on Europe, or do you look at Asia at all?
No, we're across the world. Essentially at the moment, and let me say, when I say offshore bonds, we are largely in offshore corporate bonds. We have very little sovereign exposure and haven't held much sovereign exposure for the last 2 years or so. So we are particularly in investment grade corporate debt in the US. In Europe, a little bit of Japanese exposure, but nothing to talk of.
Okay, when you say investment grade, you're saying anything from BB plus upwards?
Really from BBB upwards, yeah.
Okay.
And your South African bond exposure, as of April, 30th of April, it was sitting at around 15%. Are you holding that
Correct.
position?
We're holding that position at the moment. Again, within that, we are over 50% in South African corporate bonds, because we like the spread that we're getting, and we do a lot of our own analysis. We're fortunate that we have one of the bigger credit teams in the UK backing us as well, so we use their process. And within the South African bond exposure, over 50% is in corporate bonds.
Looking at property, I see your exposure on that front in the Prudential Inflation Plus Fund is sitting at 8%. You relatively enthusiastic about the outlook for listed property at this point?
Bronwyn, we're holding property because we certainly would rather hold property than cash. We're not arguing that property. In fact, we've held closer to 14-15% in property over the last year or two. We're down to 8%, purely with cash flows, etc. So we're being a bit more selective. But having said that, you've got a forward yield on property of about 8.25, 8.5%. And although there is risk and there's some headwinds with an economy that is struggling to gain traction in many areas, we would prefer to hold property than cash.
John, just one other question. You know, South African inflation is now at risk of rising. Do you see yourself switching more from South African fixed rate bonds into inflation linkers, or do you think you've got the exposure you want right now?
I think, Ashraf, it really depends on that relative yield. We watch the relative yield very closely. Certainly, if your conventional bonds started offering close to 4% real yield, that would be more attractive than what inflation linkers are offering at the moment. So as we look at that relative yield, that will drive our decision. We have no problem taking our linker exposure significantly higher. You know, if that started going to a real, which would be great, but I don't see it going to sort of 4%, we would certainly take a great deal more exposure. But it's really a trade-off between the real yields being offered between those two classes.
Your primary objective with this fund, John, is to outperform CPI plus 5%. That is the objective that you've set yourselves.
Correct. Let me say not to outperform it, but to match that.
To match it. And
to match it. So we're trying to, our target is CPI plus 5.
Target is CPI plus 5. You also are positioning yourself for those that are wanting to retire, and perhaps also about some income protection. Would that be a philosophy that underpins your stance?
Absolutely correct. There's a huge need in this market, and you're right, the bulk of the investors in this fund are people either in retirement or close to retirement. And essentially there are two targets. One, the inflation plus 5 target on a rolling 3-year basis, because we recognize you're unlikely to hit that every year. And the goal of this fund is to try and avoid any capital loss on a rolling 12-month basis. It's been running now for close to 10 years, and it has had positive years 96% of the time on a rolling 12-month basis. So we're happy with that. We tend to use active asset allocation to achieve it. We're not really players in the derivative market for this fund, so we're not buying options or anything like that to try and protect ourselves. Essentially, it's an active asset allocation around a strategic core that is driving the long-term performance.
John, just before we let you go, your view on the statements from US Fed Chairman Ben Bernanke last night, and the fact that QE3 certainly wasn't tabled last night, but we've had discussion on the desk this evening saying that we're probably going to see this surreptitiously slipped into the US system. Perhaps he learned that the big bang approach with QE2 was not the right way to go.
Well, Bronwyn, we're always very wary of trying to second guess central bankers or even markets and trying to predict what will happen. I think we wouldn't be surprised if there was no official QE3 sort of announcement. I think that's really factored into the market. What I think we're sort of toying with is the fact that rates are likely to remain lower for longer, particularly in the United States. We know that the ECB has done something different, but in the United States we would not be at all surprised if they keep rates lower for longer well into 2012 and towards the end of that.
John, thank you so much for your time. Much appreciated. Look forward to chatting to you again. John Kinsley from Prudential, South Africa. After the break, we speak to Vuyo Mvulani from 274 Investment Managers. Don't go away.